Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Saturday everybody. I hope you are all having a restful weekend. Before we start with the main developments, which will be entirely focused on the Chinese economy today, one quick thing. As anticipated, Russia and the People's Republic of China have confirmed that General Secretary Xi Jinping will be visiting Russia next week from the 20th of March, Monday, until the 22nd, Wednesday. Yesterday, the Kremlin confirmed that the two leaders will discuss the war in Ukraine, military technical cooperation, and energy trade. In addition, several bilateral documents will be signed during the visit. We are still waiting for confirmation of a possible Xi-Zelensky conversation. We will follow the trip as it unfolds next week. Okay, now for the main developments. Yesterday, Friday, the People's Bank of China, China's central bank, cut the reserve requirement ratio for almost all of its banks by 0.25 percentage points in an effort to boost economic activity and ensure liquidity in the banking system. This is the first cut since December. This week, we saw a lot of mixed economic data for the first 2 months of 2023, with unemployment still at a stubborn high and investment driven by government spending rather than private investment. Falling exports continue to drag on industrial output, and retail spending, a proxy for consumption, is moderate but not as strong as previously hoped. Quote, the timing of the cut could be due to concerns that credit growth could slump in April, following the completion of financing for a number of government-led investment projects early this year. End quote. There are other motivations too. Quote, this is about topping up the leading capacity of banks after strong long-term corporate loans and local government bond issuance to fund infrastructure and manufacturing investment in January-February. End quote. And there are systemic concerns too. Quote, with the domestic banking industry's debt repayment costs under pressure and the net interest margin continuing to narrow to historic lows, the central bank lowered the reserve requirement ratio to release long-term liquidity to the financial system. End quote. Storms in the international banking world are relevant too, with the state-run The Economic Daily writing yesterday, quote, currently the risks in the overseas banking industry are increasing and the external environment is becoming more and more complicated. End quote. Analysts anticipate a further cut in the middle of the year, when liquidity tends to tighten, and perhaps again in the fourth quarter. Next up for the economy, on Friday, the Ministry of Finance published new data on local government finances, which, among other things, showed that China started the year already in deficit for the first time since 2020. Perhaps most notable was that land use sales remain very weak, despite other data this week showing that there may be stabilization in the property market. Of course, we remember that land use sales are a critical source of revenue for local governments. Bloomberg's Hong Kong team reports today that the broad deficit in the budgets for all levels of government was 78.4 billion yuan, 11.4 billion, in the first 2 months of this year, adding that Friday's fiscal data suggests that the budding economic recovery and the signs of a bottoming out in the real estate sector are yet to translate into a rebound in land sales or an increase in taxes paid by businesses and individuals. In 2022, the government saw a record deficit of 9 trillion yuan, $1.3 trillion US. Next up, more on the economy. Hey guys, if you enjoyed today's episode, don't forget to hit that like button. Anyone who can go that extra mile and help me keep the channel sustainable. I rely primarily on subscribers like you guys to keep the channel going. Patreon and Buy Me a Coffee links are in the description below. Unfortunately, it does look like YouTube is still unsubscribing people. I don't know what the issue is, but if you believe that you should be subscribed, maybe check this now. And if you enjoy these episodes, maybe consider subscribing if you haven't done so already. This is also a big help for the channel. Okay, thank you so much everyone for the ongoing support. Let's continue. According to new data released by the US Department of the Treasury this week, China has continued to cut its holdings of US Treasuries this year. The data show that China's holdings dropped to $859.4 billion in January from $867.1 billion in December, the sixth straight month of decline and the lowest point since May 2009. Hong Kong-based South China Morning Post writes that Beijing has been increasingly wary of the US dollar's dominance in international transactions as its relations with the US have deteriorated amid growing threats of financial sanctions from Washington. It has sought to diversify, the outlet argues, its investment portfolio, but the US remains its major investment market. Some domestic analysts argue that the decline is partly due to the fall in the price of US Treasuries due to a rise in long-term interest rates in the US, though there are some notable contrarian observations too. For example, quote, "The People's Bank of China's holdings of the US Treasury securities fell to a 14-year low. But while this seems to imply that Chinese exposure to US dollar is declining, in fact, the opposite is more likely true. The People's Bank of China is simply swapping US Treasuries for US agencies, perhaps to get a yield pickup. More importantly, nearly all of China's currency intervention since 2017 has occurred indirectly, through state banks, so that if we want to know the real changes in the composition of direct and indirect reverses, we won't find them in the People's Bank of China data. A simple check here is useful. China has the world's biggest surplus by far, which means it is acquiring huge amounts of foreign currency assets. The US has the biggest deficit, which means foreigners are acquiring huge amounts of USD assets. China is also reducing its investment in the developing world. This suggests that its exposure to US dollars has almost certainly increased substantially in recent years." End quote. And finally for today, I wanted to conclude the video by observing a new report from the Peterson Institute for International Economics called 5 Years into the Trade War, China Continues Its Slow Decoupling from US Exports, which was published this week. The whole report is worth a read for anyone interested in this particular topic. Here, let us briefly examine some of the key findings. Now quoting the report directly. The war of words between the United States and China has escalated this year, especially since the Chinese spy balloon episode that forced Secretary of State Antony Blinken to cancel a much-anticipated trip to Beijing in February. But the US-China trading relationship was recently reported to have hit record levels in 2022, suggesting that the supposed economic decoupling of the world's two biggest economies has not yet arrived. That widely reported data point, this report writes, was misleading, however. The US exports to China, which cratered during President Donald Trump's trade war of 2018 through 2019, are continuing to suffer. China is now shifting some purchases of foreign goods away from the United States. Both have the same fear, that the other side will suddenly weaponize trade flows, cut off imports or exports in the name of security. Trying to get ahead of that, each is now attempting to diversify. China's turn away from US exports began alongside its imposition of tariffs in response to Trump's trade confrontation, starting in 2018. Trump and President Xi Jinping announced a truce in January 2020, at which point China pledged to increase its imports from the United States by $200 billion over 2 years. For varied reasons, China did not come close to meeting its pledge target. US exports to China barely reached pre-trade war levels, even by 2021. The report continues. Newly released data from 2022 show that US exports are falling farther and farther behind foreign peers also selling into the Chinese market. Once major US manufacturing exports like automobiles and Boeing jets have all but disappeared. Semiconductor sector sales trailed off in 2022 and also may not return due to new US export control policies. US services exports plunged during the pandemic and have not yet come back. Even where US exports appear to be doing all right, US farm sales to China in 2022 hit record highs. Worrying signs have emerged. Much of the agricultural gains were not the result of increased shipments, but simply higher prices and concerns over global food insecurity associated with the Russia-Ukraine war. Furthermore, Chinese buyers are diversifying toward other suppliers, while the US agricultural sector remains highly dependent on the Chinese market for its exports. While there were challenges, of course, US-China trade was also once mutually dependent and beneficial. The real news is that US exports to China are one more channel through which the bilateral relationship continues to deteriorate. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a wonderful day wherever you are, a great weekend too, and I will see you all on Monday.